The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Show with Juliana Tattlebaum. These are your headlines today. China ramps up stimulus from rate cuts to liquidity injections, while Washington announces US officials will hold trade talks with their Chinese counterparts in Switzerland this weekend. India launches attacks on Pakistan and the contested Kashmir region in response to the killing of Hindu tourists last month, the worst flare-up in tensions between the nuclear neighbors in decades.
And Danish drug maker Novo Nordisk cuts its full-year guidance despite posting an 18% jump in quarterly sales. We'll talk through the outlook and competition in the pharma space with CEO Lars Fruergaard Jorgensen. That's a first on CNBC conversation at 9 a.m. BST.
So raise the white flag. The Chinese and Americans are meeting in Geneva and Switzerland over the weekend. You're going to hear all the Swiss jokes now, I think. And of course, we talk about Geneva. This is the watchmaking capital. Time is ticking on the 90-day window. So it's somewhat fitting, I've got to say. I've been in Geneva over the weekend. There's not much going on. So anyone based in Geneva will no doubt see some of the fanfare around these talks. But will fondue, a little bit of Swiss wine and chocolate make any difference to this relationship?
Will it do the trick? It's a tall ask. And I think Scott Bessent, while he struck a more positive tone, I think it's still very unclear what these talks are actually going to yield, these China-U.S. talks, but certainly a positive sign that they are talking.
Yep, timely, isn't it, as we talk about where we're at this point. Well, China's central bank, meantime, has announced plans to cut key interest rates as Beijing looks to boost its economy amid the ongoing trade war with the United States. The PBOC said it will cut the 7-day reverse repurchase rates by 10 basis points and lower the amount of cash banks must hold and reserve 50 basis points, releasing around 1 trillion yuan in additional liquidity into the market. That's almost $140 billion. US Treasury Secretary Scott Bessent and Trade Representative Jameson Greer are set to hold talks on trade and the economy with their Chinese counterparts in Switzerland within days. Speaking to Fox News, Bessent said the countries have shared interests and that the weekend's talks would likely be about the de-escalation required to move forward. Emily Tan filed this report.
China announced the first set of economic support measures since President Trump's Liberation Day and his tariff war. The People's Bank of China announcing a 50 basis point cut to the RRR effective from May the 15th. The cut will release 1 trillion yuan, $139 billion in liquidity into the market. The policy rate will be cut by 10 basis points, which also leads to a cut in the loan prime rate by the same magnitude. Speaking at the interdepartmental press conference this morning, China's securities regulator says the U.S. tariff policies have brought great pressure to China's capital markets, and in response, it will forcefully promote long-term capital into the stock market, adding that it will help A-share listed companies affected by tariffs to cope with difficulties. Meantime, the financial regulator said it will take further steps to stabilize the stock market and guide financial institutions to maintain steady financing support to the property market. Today's announcements help to lift Hong Kong and China shares, which are also reacting to confirmation of U.S.-China trade talks in Switzerland. Vice Premier He Lifeng is traveling on the invitation of the Swiss government and is expected to meet with Treasury Secretary Scott Bessent and USTR Jameson Greer while he is there on Saturday and Sunday. I'm Emily Tan reporting in Hong Kong. Back to you.
Well, we kicked off the show talking about a ticking clock, I should say. A ticking clock. Geez, that's hard to say this time. A ticking clock. And effectively, I think the market was looking at a 90-day window here, the extension that we saw around this pause around tariffs. But it would ask the question whether time is already against the Trump administration, whether that underestimated the opposition they would get on the trade front, just as Trump underestimated the pushback he'd get on settling any agreement or reaching an agreement between Ukraine and Russia. Because the reality is, if you look at the stock market now, is it just looking for some sort of agreement? Or are there issues now that we're talking about recession, stagflation because of all of the uncertainty? And what jumped out to me yesterday was comments from Paul Tudor Jones saying, look, they do expect that there will be a dial back to the triple-digit percentage increases that you've seen on tariffs, maybe getting back to a 50% level, but saying even if we do get that, we could still go back to new lows on the stock market. So again, going to the point, is this trade war already too long in the tooth for the markets, and we've still got the onslaught of some sort of growth shock coming?
I would argue that when you look at the markets, the recovery has really been extraordinary, and investors are hanging on to every piece of good news. So the market seems to want to believe that we will get a de-escalation, and that they are buying into it, and that the U.S. economy is actually in a pretty decent place, and we're not seeing layoffs happen. So that actually, all that talk about the toothpaste being let out of the tube and not being able to put it back in may have been overdone. I think there's a lot in here in terms of China's stimulus measures that were announced overnight. Clearly, the Chinese government is concerned about some of the data that they're probably seeing now. They've got April figures to get some insight into how the economy is reacting to the trade war, and they've launched a massive wave of stimulus measures, but I think it's still unclear how effective these stimulus efforts will be to stimulate the Chinese economy.
To your point around the toothpaste, I think there have been a lot of learnings of the past, and the reality is we've had a very strong labour market that has been born out of skill shortage. And now as we talk about immigration, I was seeing some of the messaging and congratulations from the Trump administration for immigrants who'd taken themselves off using the means, the fee that they're given if they take themselves back home voluntarily. That you've got an employer now concerned they may not have the ability to hire workers if they need them in future, if you see a recovery take place. So in that mindset, there's still a skill shortage issue. But the reality of the new inputs we plug in here, if we do see tariffs start to hit the shelves, those price increases, how does the consumer react? Do they then turn around to the employer again and say, look, I need more money because, look, we're back in an inflationary environment. And we know that wage price spiral is something the Fed was very keen to stamp out last time round.
Well, let's pick up the conversation about the Fed in just a minute, but taking a look at U.S. markets, let's see how the investment community reacted. Well, we've got, in terms of U.S. futures, we have seen them move sharply higher on the back of news overnight that these trade talks would be taking place. This follows a negative session for Wall Street, though, during opening hours. The Dow, the S&P, and the NASDAQ all pulled back yesterday, but we did close off the lows of the day. The Dow Jones losing just under 400 points. Ultimately, the NASDAQ about 0.9% lower. Asian trade overnight is where we're seeing a strong reaction to China's stimulus efforts, or shall I say positive reaction. I wouldn't necessarily categorize it as strong. Fairly contained in terms of the magnitude, and I think that comes down to the fact that it's still unclear how effective these stimulus measures will be in supporting and driving growth in the domestic Chinese economy. So you've got the Shanghai Composite about 0.5% higher, the Hang Seng market about 0.5% higher as well. European futures, let's take a look at where things stand right now. You've got a bit of red on the board, a bit of green, so mixed picture for European trade.
Ahold Delhaize maintained its full-year outlook after net profit and sales beat expectations in the first quarter. Let's get to Yolanda Put-Bial, who is the CFO of Ahold Delhaize. Thank you so much for joining us, Yolanda. Just give us a sense first up of how the tariffs are having an impact, whether that is driving up some of the prices even at this early stage, and whether you're now getting worried about any shortage on the shelves.
Well, good morning, and thank you for hosting me. On the tariffs, an important question, of course. We monitor the developments closely, but keep in the back of your head that our business is a local business. So over 90% of our products are sourced locally, both for the US and for Europe. So we're somewhat protected against the tariff volatility.
What about the consumer behaviour from here? Because we know the consumer is much more sensitive to inflation, prices going up, especially on high-frequency items. Have you noticed any change in those habits by consumers even at this early point?
Well, consumers, our customers, they are looking for value, and they know how to find it as well, I would say, because if I look at our sales in the quarter, we were up with 5%. And I think that is reflecting, for example, the price investments that we're making and the assortment of our own branded products that we are expanding. And with those price investments and own branded assortments, we offer lower prices and high quality product. And that is exactly what our customers need at this moment. So despite the volatility that we, of course, recognize in the environment, we stay laser focused on serving our consumers Also, for example, with our cost reduction programs, last year we reduced our cost level with 135 billion of euros. And also for this year, we have a target of at least 1.25 billion euro of cost savings. So we're doing everything we can to serve our customers in these volatile times.
Yolanda, you've certainly chosen the right time to be investing in private label given the pressures facing the consumer. Can you just flesh out for us a little bit more what you're seeing in terms of customer patterns in the U.S.? I know the bulk of your profitability comes from the U.S. To what extent are customers trading down and shifting to those private label goods?
Well, we do see our private label, our own branded product, as we call them, we see them increasing. And in our Growing Together strategy, which we launched last year, we stated that we want to increase that own branded product assortment to 45% of total assortment. It's not easy to step it up quickly because you want to have high quality products and you want to have the right pricing in there. So it's step by step. But versus last year, our own branded assortment has increased with 1.1%, which is a good step towards that 45% that we're aiming at.
We have seen reports that in the U.S., customers at grocery stores are increasingly using buy now, pay later to buy groceries. Are you seeing that in your stores?
No, we don't see that trend increasing yet. So we don't experience that. But like I said, we do see that our customers are more and more seeking for that value item. So the way we serve them is increasing, for example, in Europe, the level of our so-called price favorites. Price favorites are products in our own branded assortments that match the prices of discounters one-on-one. So within our supermarkets, customers that have smaller income to spend can look for those price favorites and that will match discounter prices. So we have many initiatives ongoing to serve our customer in this period of time.
Yolanda, there's been a lot of options around the household discretionary items, thanks to the likes of Temu in recent times, that a lot of consumers could simply just buy online, very cheap price, and it turn up many weeks later. Now with the changes to the tariff policy to de minimis, it means that these prices have gone up much more aggressively. What does it mean in terms of the habits you're seeing in some of those discretionary household items? Are consumers turning back to you to buy some of the things that they might have been buying online previously?
Well, our online sales has been growing double-digit for the fourth consecutive quarter. And in the US, it was an all-time high of 17% growth in this quarter alone. So we do see that our online sales are increasing at a high pace. So no, we don't see that trend yet in our company.
Can you give us a sense of the health of the Dutch market? We've talked a lot about the U.S., and it sounds like your customers are trading down to some extent, but demand holding up okay. What are you seeing in the Netherlands?
Sorry, the sound was gone for a little second. So was your question how the Dutch market is evolving?
Exactly.
Okay. Dutch market, yeah, the Dutch market is within our brands represented by Albert Heijn, Ethos, and Gal&Gal. And if we look at the biggest brand in our portfolio in the Netherlands, which is Albert Heijn, we've grown our market share in the first quarter. And the example that I just gave about the price favorites, this is exactly what the strategy of Albert Heijn looks like. Albert Heijn is really well positioned from two fronts: the price favorites, matching those discounter prices. They also play a big role in making products more healthy. So they've expanded their so-called Terra plant-based assortment to over 350 products at this point in time. So Albert Heijn is affordable, providing healthy food, and a dominant market leader at this point in time, and also have grown market share in the quarter that we just closed.
Yolanda, you mentioned online sales before, but can I just hone in on the Superfast grocery category? You have this partnership with DoorDash, and we know that Superfast groceries has been a growth area for the takeout platforms, but also for the grocery stores themselves. What sort of upside are you still seeing in this area of the market? How much more growth is there to extract?
Well, we are growing fast with our DoorDash proposition, and we are rolling out more and more sites that are supported by DoorDash in our company. Currently, Food Line saw the biggest increase in our portfolio in their online sales, especially supported by the DoorDash collaboration that we have. So the Dash Bash, as it is called, is really a successful item in our assortment and really valued by our customers. So we're happy with that collaboration we have.
Yolanda, let me just wrap up on the outlook in terms of food price inflation. I take it that you do source locally to a large extent, but what are your assumptions around food price inflation in the U.S. for the coming quarters?
Well, we don't predict food inflation, so we rely on the expert bureaus in that field. We saw a reasonably stable to slightly growing inflation in the first quarter. And if we look at the predictions that are around us, a slight increase or an increase in inflation is expected, but it's not up to us to do those projections.
Appreciate your time this morning. Yolanda Putz-Bilt, the CFO of Ahold Delhaize.
Thank you so much for having us.
Let's take a look at U.S. futures and see where things stand right now. I mentioned the sharp tick higher that we saw on the back of headlines around those U.S.-China trade talks taking place this weekend in Switzerland. And there you have it. All three of the majors are looking to gain some ground at the start of trade today. Now, it is not just trade in focus. The Fed is also taking center stage today, set to deliver its rate decision later this afternoon. Markets see a 98% chance of a hold, according to LSEG data, with attention on Chair Jerome Powell's commentary on the policy outlook. Steve Leisman has more on what to watch.
Amid forecasts for higher inflation but greater concern about recession, respondents to the CNBC Fed survey are increasingly confident the Fed will cut interest rates, but don't see the Fed acting preemptively. The CNBC Fed survey shows 100% think the Fed will keep rates unchanged at the May meeting, and 77% say the Fed should keep rates unchanged. So not a lot of agreement with the idea that the Fed should be cutting interest rates now, but they will over time. 3.7 is the forecast for the year-end funds rate, down from 4.33 at the current rate, and by 2026 it drops to 3.36%. This happens amid a 53% recession probability, up 30 points since January for the biggest two-survey increase we've had since 2022, when the Fed began hiking rates sharply to battle inflation. Asked what the Fed will do in the face of higher prices from tariffs but weaker growth, 65% say the Fed will cut in the face of that dilemma, up from 44% in the prior survey. 26% say the Fed will hold in that scenario, down from being the choice of the majority in March. The change of heart looks linked to the surge in the chance of recession, a rise in the expected unemployment rate, and a greater belief that tariff-related inflation will be more in control by 2026. The March Consumer Price Index came in at 2.4% year over year. That's seen rising this year to nearly 3.25%, but then declines next year to 2.6%. Lou Breen from DRW Trading writes in with the survey, quote, "The Fed must project an inflation-fighting stance, but in most circumstances they will react more quickly to labor market weakness. When the unemployment rate rises a few more tenths, the Fed will lower rates and suggest economic weakness will dampen inflation." The growth outlook shows a sharp decline from 3.1% last year to just 0.8% this year, but then bouncing back to above trend at 2% in 2026. The unemployment rate rises by about a half a point to 4.7% from the current rate of 4.2, but remains at 4.6 in 2026. So while cuts are forecast to address expected economic weakness, the Fed is not seen acting preemptively, waiting for the data. So the first cut is not fully forecast in the survey until July, and the second one not until September. Steve Leisman, CNBC Business News.
Coming up on the show, India launches strikes on Pakistan, pushing the nuclear neighbours to their worst dispute in over 20 years. We'll have the details. Plus, Friedrich Merz is officially elected as German Chancellor on a surprise second round of voting. Annetta will have the latest. And Charlotte will be joined by the CEO of Novo Nordisk after the company cuts its outlook despite posting a Q1 profit beat. Don't miss that first on CNBC Conversation at 9 BST.
welcome back. India has launched military strikes on Pakistan, pushing the nuclear-armed neighbors into their worst military conflict in more than 20 years. Pakistan called the strikes an act of war and claimed to have downed 5 Indian fighter jets. The clashes between India and Pakistan have forced airlines to reroute and cancel flights. Dozens of flights were diverted to avoid Pakistan's airspace overnight, with flights from India to Europe also seen taking longer routes, according to Flight Radar 24. Our colleagues on Inside India spoke to Pakistan's Minister for Information and Broadcasting and asked about potential retaliation.
Our response is ongoing because our civilians, innocent civilians, women and children, our mosques were attacked without any evidence. We have shot down 5 Indian planes and 1 Indian drone in their own territory. Indian media has now accepted that. We've also destroyed many of their posts along the line of control in Kashmir. So I think we've given a very befitting response. Our Prime Minister Shehbaz Sharif has called the National Security Committee meeting, the highest forum for security matters, in 1 hour 30 minutes. So we'll probably be issuing a declaration from there. But our response is ongoing. We have shot down their fighter planes in their own territory. We've not targeted. You see, there are certain code of ethics in war. We've not targeted any civilians. We've just shot down fighter planes, 1 drone, and we've targeted their military posts across the line of control.
Now, this story, this clash, couldn't come at a more tricky political time for India. We've been talking for the last several weeks about how India is trying to position itself as a stable and capable alternative to China amid the trade war. We're talking about Apple moving the bulk of their manufacturing operations for U.S. iPhones to India. And we've been just hearing lots of this, that India is a viable alternative. Now, if we're looking at a situation where we've got a potential crisis in India, to what extent does this jeopardize some of the efforts India has made to lure Western companies on the basis that they are a stable trading partner and a solid place to do business?
It's a great point, isn't it? As we talk about resilience in supply chains, just how resilient would India be if it was engaged in more conflicts here across the border? And I don't think Trump offered much in the way of help here. It was almost washed his hands of it. So I would ask too, as we talk about geopolitics in the mix, what is this lack of leadership from the US doing to skirmishes around the world? Will we see more of it? And this is a long-running one. This has been going for many, many years, but obviously it's flared up recently. And is that timing significant that it coincides with the lack of leadership we're getting from Washington?
President Trump just said it's a shame. I mean, obviously it's early days, and hopefully the conflict does get resolved in terms of loss of life, and it doesn't escalate from here. But he did effectively wash his hands of it for now, anyway.
And to the point where we've now got more business lines with India, and we saw a significant one yesterday for the UK, finally inking a trade deal with India, and this has been a long time in the making. It has been the first significant one since Brexit, so that is 5 years on. We've now finally got a trade deal. Unfortunately for Keir Starmer, his first name rhymes with tier, because the big fallout here was that there was a 2-tier visa system effectively on contributions that those coming from India would pay for the national insurance contributions. And I think this has come at somewhat of a personal cost for him politically, that he's had to ink that type of deal because national insurance contributions in this country have gone up recently. And this is a big one because it's costing the high street, it's costing a lot of retailers and businesses much, much more. So to cut such a concession to India is a highly political one. But I would make the point, though, as we talk about tariffs, I thought it was very significant to see the level of tariffs that India has had on some UK produce, and almost to Trump's point about these tariffs being too high in some countries and that they're doing a negotiation. So whiskey tariffs to be halved from 150%. I mean, as we talk about that level, it's been called an embargo in the past. It's not doable to sell product at that level. So 150%. That goes to 75% before reducing to 40% by the deal's 10th year. So it's still high relatively at 40%. And auto tariffs go from 100%, again, embargo levels, down to 10%. So significant movement here on this free trade agreement.
Absolutely. And I think that India is showing, to my initial point, that India wants to open up to foreign investment. They want to do trade deals like the one you just outlined with the UK. But there has always always been political risk around India. And I think in terms of the conflict in Kashmir, one thing to bear in mind is Islamabad's close ties with China, and whether if we do see an escalation in this military conflict, does China come into the mix and complicate matters even more? And again, if this turns into something even bigger, is this going to be something that delays further trade deals like the one we got between the UK and India?
Well, that's a good point, because there's been enormous tensions over the years, much quieter between China and India about which would be the fastest growing region. And the Silk Road projects that China was building out in recent years before the geopolitics kicked in was effectively through Pakistan to bypass India, to bypass that shipping route that would go past India. So there is certainly a lot of background for China to be invested in Pakistan. But when it comes to the broader trade deal, I would say that there could be some torchbearing from Keir Starmer here. The Europeans, the Americans, all keen to ink some sort of trade agreement with India. Could this be some of the earlier areas where there's now low-hanging fruit? You did it for the British, you can now do it for the Europeans or the Americans on some of these areas.
And once again, Keir Starmer, I think, surprising many who didn't expect when he came to the helm of the UK that he would end up being such a global leader. I mean, he's turned into quite the diplomat, I think, in the last several weeks.